So let's go through the first one now, which is reduction of coverage. You remember that we said that Jessie had a $200,000 life insurance policy, basically, and she said, I don't think I need $200,000 anymore. I think all I need is $150,000. So we're going to go from $200,000 to $105,000. So obviously now what we got is a partial surrender. Just by the fact that you're reducing amount of coverage, you actually have a partial surrender of 25%. In other words, she's reduced her policy by 25%. How we get that, of course, is the original $200,000 minus the $105,000, which is the new coverage, divided by the old coverage of $200,000, throws up 25%. So basically what happened here is Jesse's reduced the amount of coverage basically by 25%. Okay. You'll also recall the full CSV was $24,000. In other words, before she reduced it was all $24,000 plus her cash surrender value that she had. Now, because she's actually reduced the amount of coverage by 25%, then it throws up a partial surrender amount of $6,000. In other words, she no longer can shelter, let's say, $24,000 anymore. So it throws off, let's say, $6,000 worth of CSV. So how do we get that? 25% of $24,000 is the $6,000. So as you can see, that $24,000 was essentially sheltered, which we will talk about sheltering of exempt policies in a future video and everything else. Okay, but for our purposes today, let's say she had $200,000. She's got $24,000 of basically tax sheltered money sitting in there. Okay? But now the fact that she turned around and reduced her coverage by $100,000 to $105,000, so she reduced it by 25%. That $24,000 now goes above the line, so to speak, and so therefore it throws up $6,000 worth of actual cash sitting there that she's going to have to pay some tax on that $6,000. In other words, a portion of that $6,000 is going to be taxable. The question obviously is how much of it is going to be taxable. So once again, we got to go back to the same old story. What is the ACB? Now, the full ACB, if you remember, was $10,000. Well, we no longer need a full ACB because she only did a partial surrender of 25%. So a prorated ACB is what we have to calculate. So the prorating is $2,500, which of course is 25% off the $10,000. Remember, the $10,000 was the full ACB. But now, because she's reduced her coverage by 25%, that means her ACB also drops by 25%. Okay, so now the new prorated ACB is going to be $2,500 for that $6,000. Okay, not for the entire policy, for that $6,000. The new ACB is going to be $2,500, so 25% of the $10,000 is $2,500. Okay, the other $7,500, of course, stays as ACB for future consideration. Okay, but in other words, we have now removed a certain amount of money from here. So the end result is we now have to figure out how much of this is really the new policy gain. So the new policy gain then will be the $6,000. Remember, that's how much money was thrown over once you reduce the coverage by 25%. Okay, so off the $24,000, $6,000 was thrown offside, you might say. So we got $6,000 that's been thrown offside. We only have a $2,500 ACB. That's the new ACB. In other words, the prorated ACB is $2,500. So we've got $3,500 of that difference. Basically, $3,500 is being is the actual gain. Okay, so the taxable payable on that is $3,500 times. Remember that 35% is the marginal tax rate that Jessie had, so therefore she has to send a check to Ottawa for $1,225. Okay, so just a quick review of this, because I know it gets very confusing in all this, is that basically when we reduce coverage from one number to another, as we've done here, the $200,000 to $105,000, the first thing we have to really calculate is what is the percentage of actual reduction. And so we take the 200 minus 150 divided by 200, and in this case here is 25%. So now we know that everything depends now on that 25%. So basically everything reduces by 25%. Okay, so now that we know that factor, we go back to basically square one and say, okay, well, what was the original cash surrender value? It was $24,000. Okay. But because we've surrendered 25% of the policy, that means that base 25% of that 24,000 now is offline. In other words, it's gone over the line, and so therefore there's going to be a tax implication here, basically. Okay, so the 25% of 24,000, $6,000. So now the question is, how much of that $6,000 will in fact be taxable? And just like we did a prorating of the partial surrender, we must also do a prorating now of the adjusted cost base. So the ACB was $10,000. That was the original ACB, but because we've reduced it by 25%, the new ACB for that, not for the whole policy, just for that alone, okay, is $2,500. So just like we did before, policy gain is proceeds, which is of course $6,000 in this case here, minus the ACB, which is the prorated ACB, which is $2,500. So throws out $3,500. That $3,500 now, which is basically the actual gain itself. She's in a 35% marginal tax rate, so 35% of $3,500. She has to send out a check for $1,225. Okay, so that's how we calculate the basically if there is any kind of policy gain in the event that the coverage actually reduces. So remember, so before we said full surrender, but the policy was gone. Here you say, no, I don't want to surrender the entire thing, but I would like to reduce my coverage. What are the tax implications of reducing my coverage? Well, this is the tax implication of reducing the coverage. She will have to send auto one, in this particular example, $1,225, okay? So the next example, we're going to be an actual partial withdrawal. In other words, actual money coming out of the policy.